investing in US stocks is an appealing option for many Australian investors. This process is becoming more accessible and affordable, facilitated by new online brokers including Stake and Selfwealth. In this video, we'll take a look at the costs, the tax implications, and complete a comparison of the best brokers that offer a US investing service. Welcome back to another episode of the Aussie Investing Machine. Thanks for joining me again this week. In this episode, as I said in the introduction, we'll be taking a look at US stock market investing from Australia. I know this is a topic that many of you viewers are interested in, so I hope you can take something from this video and apply it to your investing approach. If you haven't done so already, make sure to subscribe to the channel and hit that like button. It really helps with the growth of the channel. As always guys, this video is for educational purposes only and does not constitute financial advice. Before making any investment decisions, make sure you do consult a licensed financial advisor. With that out of the way, let's get straight into it. So what are the costs of investing in US stocks from Australia? Well, going by the traditional approach and using one of the big four banks such as CommSec, ANZ or NAB Trade, you'll expect to pay around $20 per trade. This cost does go up slightly if you're buying more than a certain dollar value of US stocks, but for this comparison, we'll go with $20 per trade. In addition to this $20 trade cost, there's also a foreign exchange fee. Now this varies from bank to bank, but it's typically around the 0.6% mark. CMC Markets also has a US investing service. Their fees for buying and selling are similar to CommSec's, and so is their transaction fee. Selfwealth, which is a newer Australian broker, has a flat rate fee of $9.50 US per trade. This is combined with a 0.6% foreign exchange fee. Finally, the company Stake, which focuses solely on US investment, does not charge a buying and selling fee. They do, however, charge a slightly higher foreign exchange fee of 0.7%, which is 0.1 higher than Selfwealth, who again was at 0.6%. So that's a brief overview of the costs that are available on the market at the moment. For the purpose of this video, I wanted to focus on Selfwealth and Stake because they represent the best value in terms of US stock trading. I wanted to break the comparison down into the following components, and they are security, dividends, stock ownership, company ownership, and then finally tax. So let's first talk about security. And by security, I mean how safe your investment is with a given company. Certainly the trust in Australia for the big four banks is huge. They're essentially backed by the government should anything go wrong. And we know they've been operating for a very, very long time. So there shouldn't be any dramas investing with one of those corporations. On the other hand, Stake and Selfwealth are relative newcomers to the market, so it's worth going over what sort of protections they have in place for investors. So Stake's US broker-dealer is called DriveWealth LLC. Now DriveWealth is a member of FINRA and SIPC. These are entities which protect investors up to a certain investment amount. In Stake's case, investors are protected for securities up to $500,000 and for cash claims up to $250,000. For Selfwealth, ASIC regulates their trust account, which is where all of the investors' money is being held. A trust account means this money cannot be used for any corporate purpose, and in the event of a liquidation or the company goes into voluntary administration, this money is protected. Furthermore, Selfwealth investors' funds are backed by Australian government schemes, which protect investors up to $250,000. This includes money within the Selfwealth cash account. So we know that both companies offer good protection up to $250,000. It's not clear for Selfwealth what happens over this amount, but we do know that Stake offers protection for securities up to $500,000. So all in all, quite similar, but it's probably worth asking Selfwealth what the protection is over $250,000 if you are planning on investing more than that amount. Let's move on to dividends for US stocks. So for Selfwealth, dividends are paid within 48 hours of a dividend being issued, and this money goes into your US cash account on the platform. On Stake, dividends are paid 2 to 3 days after the payment date, and these are paid into your brokerage account. So very similar to Selfwealth. In terms of dividend tracking, Currently, Selfwealth does not offer a dividend tracking feature on their platform. This applies to both their US stocks trading and also their Australian trading platform. You can import your Selfwealth portfolio into a website called ShareSite. ShareSite is a paid platform and it does offer dividend tracking. There is this partnership there, but as I said, it does come at a cost. On the other hand, on Stake, you can track dividends on the platform and get insights into how many dividends you've been paid over time. And there's overall a lot more flexibility in this regard. So if you're big into dividend stocks and like to track your progress over time, perhaps Stake is the better option for you for this component of the comparison. So let's now talk about stock ownership. When you make a purchase on Stake or Selfwealth, where does the money go and what do you actually get in return? Both Selfwealth for US trading only and Stake are not CHESS sponsored, that's CHESS. Alternatively, they operate on a custodian shareholding model. This means that you are the beneficiary of the share and not actually the legal owner. Now, this is no cause for alarm. From what I can figure out, this is the standard way of investing in the US, and this practice is also adopted by some of the big banks such as ComSec for their US trading service. Now, looking at company ownership, I think this is a really important point and something that should be carefully considered when choosing who you're going to invest with for US stock trading. Here's the main difference. Stake is not a publicly listed company. They are in fact a private company. On the other hand, Selfwealth is a publicly traded company. They are a listed company on the ASX. So what does this mean for investors and why is it important? One main benefit of being listed on a stock exchange is that the company can quickly generate extra capital by issuing additional shares in order to fuel their long-term survival and growth. That's one benefit, but the second benefit, which I think is the most important one, is the financial reporting aspect of being a publicly listed company. Being listed on the ASX, Selfwealth must provide financial and company reporting. This reporting is audited by regulators for the benefit of shareholders. This means that any customer using the Selfwealth platform to invest can review some of these audited reports and get an idea of the health and well-being of the company itself. As these audited reports are publicly available, it allows investors to review the company's health in advance and see how they're doing year on year. If it looks like financially Selfwealth is not doing well, it gives you an opportunity in advance to move away from the platform and go towards something that's more stable. Because Stake is not listed on a stock exchange and their reports are not readily available, this means you cannot monitor the financial health of the company. For me personally, this is a significant disadvantage, especially if you're putting a considerable amount of money into the hands of Stake in order to invest. For me personally, being able to monitor the financial health of a company is very important, especially if I've got my money invested with them. We talked about the security of your investments earlier in the video, but I really think that's a last resort in order to preserve your investment. Finally, let's talk about tax implications of a US stock investment. One important item to consider when investing in US stocks is the W-8 BEN form. This W-8 form is a US Treasury document, and its purpose is to give a tax benefit to foreign investors in the US market. I'll put up an example of how this tax concession works, and I've taken this sample from ComSec's website. But essentially, even if you buy and sell a company at the same price, if you haven't completed one of these forms, you will be charged at least a 30% tax by the IRS on your investment. You can pause the video and read through this example in detail, but essentially, even if you buy and sell a US stock and don't make any money on the investment, you'll still get taxed by the IRS unless you have one of these forms populated. Now, luckily, both Selfwealth and Stake organize the population of this form before you start investing so that you won't be subject to this additional taxation. One important thing to note if you are interested in earning dividends from US stocks is that none of the US companies offer franking credits on their dividend payments. Now, this could be seen as a major disadvantage in terms of dividend payments compared to Australian stocks that offer a fully franked dividend. If you're unfamiliar with what franking credits are and how they can benefit you as an investor when it comes to tax time, make sure to check out my video on franking credits. I'll leave a link up in the corner of the screen. In essence, if you are a dividend investor, certainly sticking to the Australian stock market may prove a much wiser decision, especially when it comes to income tax. Now, looking at capital gains, yes, capital gains still apply to US stock trading. Provided you've completed that W8 form we talked about before, capital gains are charged in the usual way they get charged by the ATO in Australia. Of course, there are capital gain discounts available in Australia. These discounts apply depending on how long you've held the stock and whether or not you're investing as a self-managed super fund. If you'd like a video that covers capital gains tax in more detail, make sure to leave me a comment below and let me know that you'd like to see a video focused on that. Now, one final tax-related item that I should mention about US stock investing is the US estate tax. This is a tax that we don't have in Australia, and it's otherwise known as a death tax. If a beneficiary of US stocks happens to pass away whilst they're holding US stocks, the IRS will apply an estate tax to the investment. Now, there is a US-Australia tax treaty in place in order to provide a concession for this tax amount, but it may still apply. It's certainly something to keep in mind if you are holding US stocks as a beneficiary. So guys, that's my overview of US stock market investing. If I've missed anything, let me know in the comments below and I'll try my best to answer it. As always, don't forget to like the video and subscribe. Until next time, I'll catch you in the next episode. Cheers.